There are three golden rules. Number one, personal account, that is debit the receiver, credit the giver, debit the receiver, credit the giver. Number one, personal account. Number two, real account. Debit what comes in, what comes in to be debited. Credit what goes out, Debit what comes in, credit what goes out. It's called real account rule. Number three, nominal account. Debit all losses and expenses, credit all incomes and gain. So debit all losses and expenses, credit all incomes and gains. It's called nominal account. Fine. So debit the receiver, credit the giver. First golden rule. Second golden rule, debit what comes in, credit what goes out. Real account. Third, debit all losses and expenses, credit all incomes and gains. So these are the three basic ideas. Right. Now there are two approaches in accounting. First approach is called accounting equation approach. Next one is called modern approach. Modern approach means double entry system you have to apply. Double entry system you have to apply. What is accounting equation? See, the owner has to contribute into the business. It is called capital. Plus, he may borrow loans and other liabilities. It is called liability. Is equivalent to he may create assets. This is called accounting equation approach. So capital plus liability is equal to asset. C plus L is equal to A. C plus L is equal to A. It's called accounting equation approach. Right. Now C plus L is equal to A. Capital plus liability is equal to assets. So capital plus liability is equal to asset. We are going to see now. Double entry later on we will see. Right. Let's see. Ascertain the debit and credit from the following particular using modern approach. Right. First you will see modern approach. Next you will see accounting equation approach. Modern approach. Right. A, started business with capital. Right. Here what are the elements involved? One, we have to start with business with cash involved. Another one capital. There are two things are involved. First one is called cash, another one is called capital. First one cash, another one is capital. Right. What is cash account generally? Real account. Debit what comes in, credit what goes out. Real. What is capital? Is a proprietor's capital. It is proprietor's capital. Therefore, it is personal. Proprietor's capital. Therefore, it is personal. First one real, next one personal. Right. What is the modern approach says? What comes into the business? This is business point of view. What comes into the business? Cash comes into the business. So, cash to be debited. Then what is to be credited? Who contributed? Proprietor contributed. Therefore, capital to be credited. Let's see. B. Bought goods for cash. Here there are two elements involved. One, purchase of goods. Goods for the purpose of reselling money. Why we are purchasing? We are going to make a sales. Another one is called cash. There are two elements. One is called purchase. Another one is cash. One is purchase. Another one is cash. Right. Now, purchase of goods is a real account. Once we make a sale, that is also real account. Goods going out. The difference is the income. Purchase real, sale real. The difference is called income. Income is nominal. So purchase goods for 100, sold goods for 120. What is the profit at 20? The 20 rupees is a income. So purchase is a real. What goes out? Cash. That is also real. So purchase is a real. Cash is also real. Right. What is to be debited? Purchase account to be debited. What is to be credited? Debit what comes in. What is to be credited? Credit what goes out. So cash account to be credited. That's it. Next to C. Sold goods for cash. Which means there is a sale and there is a cash. So cash is also involved. and the sales is also involved. Sales is also involved. So cash comes in, cash comes in, cash comes in, sale goes out, goes out, goes out, right. So cash comes in, sale of goods goes out, goes out. What is to be debited? What comes in to be debited? What comes in to be debited? Cash comes in, cash comes in. So to be debited. What goes out? Sale of goods goes out, sale of goods goes out. That is to be credited, that is to be credited. So cash to be debited comes in, sale of goods goes out, credited. So cash to sales. D. Paid salary, paid salary. So here there are two elements involved. One is called salary, another one is called cash, another one is called cash, another one is called cash. So salary and cash. Why salary is debited? It is an expense. Why salary is debited? It is an expense. What the nominal account says? Debit all losses and expenses, credit all incomes and gains. So salary is an expense, therefore it should be debited. It should be debited. Debited. Why cash is credited? Cash is credited. So cash goes out. Cash goes out. Cash is the real account. Cash is real account. It goes out. Goes out. Therefore to be credited. Credit what goes out. Debit what comes in. Credit what goes out. So to be credited. So salary is an expense. So debited. Cash goes out. Credited. One is nominal. Another one is real. Another one is real. That's it. E. Received interest on investment. Received interest on investment. So received interest means cash received, or either you may check received also. Either way may happen. So cash comes in and interest on investment. Interest on investment. Cash comes in is a real account. Debit what comes in, real account. Interest is a income. Interest is a income. Interest is income or gain. So nominal account. Nominal account. Cash real account. What comes in? Interest income. Income nominal account. So cash comes in to be debited. To be debited. Interest to be credited. To be credited. That's it. Let's see F. Bought goods on credit from Mr. Y. Mr. Y is our supplier. Mr. Y is our supplier. So here there are two elements involved. One is called purchase of goods. Another one is Mr. Y. Mr. Y. Mr. Y. Right. Purchase real account. Real account. Real account. Debit what comes in. Debit what comes in. Mr. Y. Mr. Y. Mr. Y. Mr. Y is going to be credit the giver. Credit the giver. Credit the giver. Therefore personal account. Credit the giver. Personal account. So purchase to be debited. Purchase to be debited. Debit what comes in. Mr. Y personal. Mr. Y personal. Credit the giver. Credit the giver. So should be credited. Should be credited. So purchase to be debited. Mr. Y to be credited. That's it. So G. Paid rent out of personal cash. So paid rent out of personal cash. Out of personal cash. Right. Generally there are two elements involved. Two elements involved. See, once we are paying rent out of cash from the office. Out of cash from the office. Then rent and cash involved. Rent and cash involved. Here we are not taking the cash from the office. It is from my packet. Personal. It is my packet. Whatever coming out of my capital. Whatever coming out of my packet to the business is a capital. Whatever coming out of a packet. It is personal. Purely personal. To the business it is a capital. But there are two elements. One is called rent. One is called rent. Another one is called capital. Another one is called capital. So rent nominal because it is an expense. Capital personal. Capital personal. Credit the giver. Property is a giver. Anything coming out of the property's packet is called capital. Capital. So rent to be debited, nominal expenses. Capital to be credited, credit the giver. Credit the giver. Credited. That's it. Let's see. Proper accounting equation from the following transaction in the books of mistakes for January 2015. January 2015. So it is purely based on accounting equation approach. Accounting equation approach. Right. What is accounting equation? What is accounting equation? So accounting equation approach. Accounting equation approach. What is accounting equation approach? So equity plus liability is equal to asset. Equity or capital, both are same. Equity or capital, both are same. E means equity. L means liability. A means assets. Liability. A means assets. So capital or equity plus liability is equal to assets. So this is called accounting equation approach. So equity plus liability is equal to assets. Okay. So assets. Right. Let's see one by one. First one. Invested capital in the firm 20,000. Invested capital in the firm 20,000. Now what are the two elements involved here? Cash comes into the business. Accepted. plus capital by the proprietor. Capital by the proprietor. There are two elements. There are two elements. One is cash, another one is capital. Cash comes in, contributed by the proprietor's capital. Amount how much? 20,000. Cash comes into the business, capital invested by the proprietor. 20,000. 20,000. So first one. Cash means asset. Cash means asset. Cash comes in. Cash comes in. How much cash comes in? 20,000 cash comes in. Asset comes in. Asset increases. Asset increases. Who contributed? Proprietor. So capital 20,000. So cash comes in, capital increases. So cash increases, capital increases. Cash increases, capital increases. Let's see. 2. Purchase goods on credit from Das and Company. First 2,000. Once a goods purchased on credit, either it's an expense or stock increases. So stock increases means it is an asset. It's an asset. From whom we purchased it? Das and Company, our supplier. So here stock asset increases. We may treat or Das and Company supply also increases by 2,000. So stock increases. Our asset increases. Purchase means stock increases by 2,000. Our asset increases 2,000. Similarly, Das and Company, our supplier, liability increases. Das and Company, supplier, increases by 2,000. So 2,000 liability increases, stock increases by 2,000. That's it. Let's see. Go 4. Bought plant for cash 8,000. Here two elements. One, plant comes in, asset increases. Another one, cash goes out, asset decreases. So plant asset increases 8,000. Cash asset decreases 8,000. So asset increases, asset decreases. These two things will comes under asset column only. So 4, third entry. Plant comes in, asset increases by 8,000. So cash decreases by 8,000. Here we have two adjustments. 8,000 increase, 8,000 decrease. Result net 0. Plant increases 8,000, cash decreases, result 0. One is increase, another one is decrease. That's it. Increases I will treat as a plus, decrease I will treat as a minus. That's it. 8th. Purchased goods for cash 4,000. Purchased goods for cash 4,000. So here the purchase of goods we may treat as a stock. Stock increases by 4,000. Cash decreases by 4,000. Stock is asset, increase by 4,000. Cash is asset, decrease by 4,000. So both things will be adjusted in asset side itself. So fourth entry, stock increases. So stock increases by 4,000. Asset increases. Cash decreases by 4,000. Cash decreases by 4,000. Asset increases by 4,000. Cash decreases by 4,000. That's it. 12th date. Sold goods for cash. Cost 4,000. Profit 2,000. Cash comes in 6,000. Here profit, which means your capital increases by 2,000. Here cash increases by 6,000. Your stock reduced by 4,000. Your cash increased by 6,000. Your profit increased by 2,000. Profit increases, it is added to capital. Okay. Your profit increased by 2,000. Your capital increased by 2,000. So number 5. Profit. Profit means your capital. Your capital or profit increased by 2,000. Right. Your cash increases by 6,000. Your stock decreases. Cost means stock. Your stock decreases by 4,000. So profit means capital increased by 2,000. Cash increased by 6,000. Sold for cash 6,000. Your stocks decreased by 4,000. Cost means stock decreased by 4,000. That's it. 18. January 18. Paid to Das and Co. in cash 1,000. So here supplier Das and Co. reduces. Liability reduces by 1,000. Cash liability decreases. Paid to Das means liability decreases 1,000. Cash reduced by 1,000. Liability decreased by 1,000. Cash decreased by 1,000. Paid to Das means loan don't decrease. Liability decreases. Das decreases by 1,000. Cash decreases by 1,000. So liability Das. Liability means Das. Liability or Das. Decreases by 1,000. Similarly, our cash decreased by 1,000. Liability decreased by 1000, cash decreased by 1000. Decrease means minus. Okay. Next entry. Received from Banerjee 300. Received from Banerjee 300. So cash increases by 300. Banerjee is our debtor. Debtor decreased by 300. Banerjee is our debtor. Debtor decreased by 300. Our asset decreased by 300. Debtor means asset. Asset decreased by 300. He paid. Debtor increase means asset increases. Debtor decreases means asset decreases. So cash increases by 300. Asset. Banerjee debtor decreased by 300. So asset decreased by 300. So number 7. Cash increases by 300. Cash increases by 300. Our debtor, Banerjee is our debtor. So debtor decreases by 300. So both adjusted on the asset side itself. Cash increases 300, debtor decreases 300. Asset side tallied. Okay. 25. Paid salary 6000. So salary is an expense. So automatically your profit decreases. Your capital decreases by 6000. Similarly, cash decreased by 6000. So salary paid means expense, profit decreases, capital decreases. Cash decreased by 6000. Paid salary. Number 8. Paid salary. Salary is an expense. So paid salary is an expense. So which means your profit decreases or your capital decreases. So it's an expense. So profit decreases, capital decreases. 6000. Your capital decreased by 6000. Similarly, your cash decreased by 6000. Your capital decreased by 6000. Your cash decreased by 6000. That's it. January 30. Received interest 5000. So here interest is a income. Cash comes in, interest is a income. Cash increased by 5000, income increased by 5000, profit increased by 5000, capital increased by 5000. So cash increases by 5000. So cash increases by 5000. Interest or income or profit or capital. So increases by 5000. So cash increased by 5000. Interest or income or profit or capital increased by 5000. That's it. So paid wages is an expense, just like a salary is an expense. Expense or profit decreases or capital decreases. Similarly, cash decreased by 3000. Just a salary mari the treat pannu. Paid wages. Wages reduces or profit reduces or capital reduces. Cash reduces by 3000. Number 10. Wages or expense or profit or capital. So this is decreases by, just like salary decreases by 3000. Here cash decreases by 3000. That's it. Now you have to make a tally. Capital tally, liability tally, asset tally. Okay. We'll do one by one. First, capital. So capital 20,000 increase means plus. Cancel 20,000 increase plus. Plus 2,000 plus 20,000 plus 2,000 22,000. 22,000 minus 6,000. 22,000 minus 6,000. 16,000. 16,000 plus 5,000 21,000. 21,000 minus 3,000. 21,000 minus 3,000. So 18,000. So capital Net adjustment 18,000. Net adjustment 18,000 capital. Increase means plus, decrease means minus, that's it. Here liability. DOS 2000 plus increases. 1000 decreases. 2000 minus 1000, 1000. 2000 minus 1000, 1000. So 1000. Liability increases by 1000. Liability, net liability increases by 1000. That's it. 18,000 plus 1000. That is equal to 90,000 we are supposed to give in the asset side. Asset side calculation. 20,000 plus 2,000 minus 8,000 plus 8,000 plus 4,000 minus 4,000 plus 6,000 minus 4,000 minus 4,000 minus 4,000 minus 4,000 minus cash 1,000 plus 300 minus 300 minus 6,000 minus 6,000 plus 5,000 minus 3,000. So 19,000 answer. 18,000 plus 1,000 net capital, net liability, net asset. So 19,000 is equivalent to 19,000. So capital plus liability is equal to asset. That's it. Subscribe to our YouTube channel Stride Edutech and press the bell icon to see new videos.